One of the topics that our wealth, tax and estate planning team are going to be talking about today is it possible if IFA deals are still happening with today's high interest rates? So I know they're going to talk about this one topic, but they're also going to talk about what's going on from a tax and estate planning point of view. And I just want to mention that both Frank Abate and Chris Britton will be presenting today, but let us not forget that we have a tax and estate planning person based in Western Canada operating out of Edmonton, supporting the West, and that's Brad Hyde. And also in the Quebec region, we have Martine Berthollet operating out of Quebec and housed in the Montreal region. So Frank, I know you're up first, so please take it away.
So good afternoon, everyone. I'm happy to present. I'm presenting on this topic. Is it possible that IFA deals are still happening with high interest rates? And the reason that I chose this topic, it's interesting. Last year, I did an IFA example. I walked through a case, and I was a little bit technical in that presentation. I basically walked through a live case of an individual that owns personal real estate. And basically, we showed some of the tax impacts that are going to happen to the estate when they pass away. And of course, we talked about how the IFA could help basically fund the tax liability, create the liquidity to fund the tax liability. So after that presentation, throughout the year, it's interesting how much feedback I got and how much questioning I got from advisors, basically asking this exact question: is it possible? Are you still doing IFA deals? Frank, I don't think that there's any chance that you could be doing them when prime has gone from 3% all the way up to 7%. And the intent of today's presentation, it's not going to be technical, because I think that the group that's watching me present right now has a good understanding of what an IFA deal is. I know that the carriers have presented at a very high level what an IFA is from a technical standpoint. And I know that in our own tax group, we've explained what an IFA deal is. So that's not my intent today. I'm not going to give you technical background. Very high level, very high level. What is an IFA? An IFA, immediate financing arrangement, is basically giving the premium owner, the policy owner, giving them the ability to access the cash that they've got in the policy. The premium that they've paid in the policy, we give them the access to that money, and that's via a third-party lender. As simple as that. Just keeping it very high level, an immediate finance arrangement gives access to the premium that we've paid into our policy. And of course, the best way for us to access our cash is via a high cash surrender value product, usually a wealth product. Most carriers have a very upfront cash surrender value product, a wealth type of product. And then the carriers also give you access to a delayed cash surrender value product. Usually they focus on an estate type product. So again, today, I'm not focusing on the technical aspects, more so how do we sell IFAs in a high interest rate environment? And what I'm going to say, anybody that's ever heard me speak knows that my main concern is that there is a life insurance need. So every IFA should start with a life insurance need. As basic as that may sound, sometimes I go into cases where an advisor leads with the IFA. They start with, hey, Frank, I think this is a perfect case for an IFA. And I step back and say, well, let's start by figuring out where the insurance need is, what the insurance need is, present the insurance solution, and then educate the client on accessing their cash from the cash surrender value. And call it an IFA, call it whatever you want. I like to call it access to your own capital. That's basically what I think an IFA is. So I'm going to run through numbers. And again, you're going to look at this presentation and say, wow, was that ever obvious? What Frank showed was extremely obvious. But sometimes it takes us to see the obvious to get it. right? And I realized that when so many advisors are asking me how I can still sell IFAs in a high interest rate environment, I figured go that extra step and just show some of the numbers and try to explain to them the methodology of educating a client as to why it still makes sense for them to buy the insurance and have access to their capital, even though interest rates, prime rates are somewhere around 7%. So this is based on a true case, true IFA case that I placed with an advisor. You can see the insurance amount is $10 million based on a 48-year-old non-smoker standard. That's actually the ESA. The actual client was a male 60-year-old, female 58-year-old, joint last die policy. The need for insurance was there because the portfolio, this gentleman had a real estate portfolio in a corporation worth roughly about $40 million. He just finished going through an estate freeze. Pref shares worth about $40 million. So his accountant says, you know, you need $10 million of life insurance coverage in order to make sure that the kids don't have to sell anything when you and your wife die. And, you know, $10 million of life insurance is going to help you do that. So if we present solution number one and we tell him, Mr. and Mrs. Client, the cost for you to buy a $10 million insurance solution is $678,000 a year, and you pay it for 10 years. Interesting. Not necessarily jumping up and down for joy. It's a very expensive spend for this individual in his mind. And then we go over to solution two. And by the way, solution one is a par solution. No leverage, just strict premium paying from years 1 to year 10. We go over to solution number two. And solution number two is basically saying, well, if you don't want a participating life policy for $10 million, a wealth type product, overfunded, of course, then let's look at a UL limited pay. So this is one of those contracts where we fund it for 10 years, and basically after year 10, it's fully funded. And I wanted to compare apples to apples in terms of 10 years of funding. So on my par solution, at year 10, the policy is paid up and it will pay for itself via, of course, the internal dividends. Solution two is that UL example where contractually at year 10, the policy is paid up and of course, you have your $10 million of insurance in place. And now I know that it's not an apples to apples comparison because solution two sticks us at $10 million, whereas the par we know has the potential to grow much further than the $10 million. But this is part of my education process, trying to compare apples to apples. Solution number three. I'm sure that just like the client, you are looking at this saying, yeah, I would pick door number three, solution number three, any day over solution one and solution two. Solution three requires much less cash outflow than solution one and solution two. Solution three would have a premium of much less than solution one and solution two. Well, what if we change that word from premium, right? So figure solution one is premium for a par, solution two is premium for a limited pay UL, and solution three is what? Well, I'm going to change that wording now, and I'm going to call it cash flow. Which cash flow would you choose for a similar starting amount of insurance? So now this changes the nature of the premium. On the left-hand side, I have annual deposits in that par contract, wealth type of a contract, where we're putting in 678 for 10 years. There's offset at year 10. And if I can't use that, business owner, he's built up $40 million of real estate, passive real estate, not related to his business. He looks at this and says, I'm not really interested in this because that's roughly $6.7 million, $6.8 million of capital that I can never use. I get it. The life insurance is a great solution, but I could make $6.8 million do wonderful things much better than what the insurance can do for me. I move over to the middle columns. The middle columns show that the spend is $3.8 million. Yeah, not as much as the 6.8, but still, that's requiring me to spend $3.8 million of capital over 10 years. Don't like it as much as this third thing, Frank. This third thing that you showed me really intrigues me. And the third thing is basically the 678, so it's the par, minus the amount that we could borrow against the cash surrender value. So this is, of course, an IFA, and I'm running this at 7%. Current interest rates. Current interest rates are somewhere around 7%. High enough. Premium is, prime is roughly around 7%, and that's what we're getting our clients. If we're lucky, we could get prime minus, but it's not much of prime minus. So let's call it 7%. So year one, individual pays 678. We borrow 582 because the cash value is 582. And the outflow of cash in year one for this gentleman or for this corporation was only 115. Now, I know what you're all thinking there. You're thinking, why did Frank do it this way? I'll tell you, I've never done an IFA where I've posted extra security. In my experience, most clients are okay with that shortfall of this $115,000. I think the hoops that we have to go through in order to implement the extra security doesn't really attract the client. Makes it a little bit more difficult for the client. So, of course, I'm not going to go through all the numbers, but what we're seeing is that every year a premium is being put in and we're borrowing back up to the cash surrender value. So if I total all of the amounts spent, the cash flow spent, you can see that at year 10, I have $1,250,000 of cash spent on the IFA. So I step back and I say, does a 7% interest rate really kill my deal? When I know that this individual, and he and his wife knows that they need the coverage. So if they need the coverage, this isn't going to work because he doesn't want to lose $7 million of capital over 10 years. This is a little bit better, but he's still not very happy. This works. He knows that he's borrowing all of this back. And by the way, he's going to cover this cash flow by buying an asset that's going to produce him cash flow to help finance the interest. Right? At the end of the day, we're not borrowing at 7% to put it into a GIC that pays us 3 or 4, or to put it into a bank account that's paying us nothing. Entrepreneurs know that this borrowing is going to yield them a return that's much higher than what they've borrowed at. So I continue to show the example all the way through to mortality. And when I'm looking at the later years, mortality in this case, he's 60, she's 58, mortality of about year 30, or even if I go all the way to year 40, we're looking at a difference of roughly about $7 million between the par solution, where if I put $6.8 million into par, it produces about 25 million, versus the IFA that produces about 18 million, assuming that I have an ending loan balance outstanding to death. Well, that's okay because the difference is the $7 million. But that $7 million allowed the clients to buy assets, no different than if they didn't do the insurance. So we're putting that client in the position of having access to their capital. And the bottom point that I have here, as an advisor, do you ever get the rebuttal? I can get a much better return if I invest my premiums instead of buying life insurance. I think that most of us that work in this area have come up against this. And this is the rebuttal to that comment. Well, Mr. or Mrs. Client, we've provided you with the ability to not lose the opportunity cost of your $6.8 million. We've given you the asset right back. You're able to use that asset right back into your premium earning, your investment strategy, your income earning needs. And here's a big thing that I like to do. I like to be realistic about when someone's going to access the funds. So don't get me wrong. I like to get the approval up front before we place the policy. So we want bank financing to be signed off. Yes, we're good to go. But does everyone need access to the funds immediately or want access to the funds immediately? And in my experience, the answer is no. So what I like to do is I like to do something where I show a realistic time frame of borrowing. So I basically take my spreadsheet and I ask the client, would you be okay if you don't have access to that money immediately? You could have it, but realistically, do you need access immediately? And a lot of times the clients will tell us, well, Frank, what if I don't need the money? Do I have to access it? And we know in our agreements with the with the banks, the agreements that are drawn up on an IFA, they don't have to draw the money immediately. So here's an example of where I change the parameters and I say, well, what if you fund for the first 5 years? Every year you put your deposit in, your cash surrender value is growing, your death benefit's growing from 10 million, and by year 5, it's up to $16 million. And now in year 5, you've got an opportunity for a purchase, an opportunity to purchase an asset. Well, I'm going to start my IFA as a deferred IFA. It's not necessarily an immediate financing arrangement. It's, again, access to capital, and he's going to access capital at year 5. $3 million, absolutely, we could borrow $3 million when our cash surrender value is $3.5 million. And then he's going to borrow again at year 10. So he does his next 5 premiums, and at year 10, this individual has $7.8 million, and we bump up the borrowings from $3 million up to $7 million. So he's borrowed another $4 million. This, to me, is a lot more realistic in terms of how they're going to access the money. In my mind, when I start showing immediate access to premium, that doesn't suit everybody. And we have to make sure that we're not trying to sell a one-size-fits-all. So again, that's why I don't necessarily like the IFA term, because we don't need to access this immediately, but we need to show the client that they do have access whenever they want. And this little deferral where I access at year 5 and I access at year 10 proves to that client that they basically have 10 years of they have access whenever they want, year 5 and year 10. And now look at what I've shown. What's the cumulative cash outflow to year 10? So this is interesting. Up to year 5, I've spent 678 times 5. That's roughly about $3.4 million. And I take back $3 million. I do another 5 years, and the total spend over 10 years is roughly $678,000 times 10. That's $6.8 million. But I've taken back $7 million. Client looks at you and says, how the heck does that happen? I've put in 6.8 and you've allowed me to take back 7 million. Of course, we all know that in our industry because cash surrender value is at 7.8 million. Of course, we could have 7 million by year 10. So he sits back and says, I'm actually plus 200,000 minus all of the cash financing, right? Minus all the cash financing on the $7 million, $3 million at year 5, all the way up to by year 10, I have 7 million outstanding. So cumulative cash outflow now at year 10 is 525,000. That's a much more realistic picture for this client. Much more realistic that they're not borrowing immediately, but they've taken back cash. And again, it's all about opportunity cost. Frank, you've made sure that I have not lost the opportunity cost to my capital. I know that if a deal comes up and I need money, I don't have to go for bank financing because you've already gotten me the approval on this. So there we go. We have it all done. And what happens by year 30? Well, by year 30, I'm just showing the annual cash outflow. And of course, the annual cash outflow is simply $7 million. It's the outstanding loan balance times 7% interest. So that's roughly 500,000, but we're saving tax on that. We're saving tax at roughly 50%. So we're not only saving tax because it's an interest deduction, We also have the NCPI deduction. We call it Section 21E.2 deduction. So on an annual basis, the spend is basically the financing charge. And if I look at the cumulative outflow, the cumulative spend for this individual, by year 30, they've spent $4.8 million. And the net estate proceeds after tax in the pockets of this couple's kids is $15 million. They've got their $10 million to pay tax on the pref shares. The extra $5 million is going to address cash needs or tax liability needs for some personal assets. So being mindful of my time, I'm going to skip over to a new concept. So what I'm going to skip to is this. I've never presented this, but I've been asked this of the clients, and they actually tell me, I'm going to go back to this page. They say, Frank, your model is fantastic, but there's an error. And I say, well, what's the error? And I know where they're going because it's come up more and more often. They say, Frank, your model doesn't incorporate that when we borrow, we're actually producing income, right? So if I'm borrowing to produce income, and let's choose a very simple asset. Let's choose a passive asset. Well, if that's the case, then I'm producing a cash flow that wipes out or covers the financing cost. So I thought that's an interesting twist. I've never shown this on a client presentation, but I thought, let me show it to advisors. That way we can see mentally what's happening here. So how would the model look if we included the asset that was purchased with the borrowed money and it earned at least the cost of borrowing, 7%, right? So of course, a business owner is not going to borrow. We hope that they're not borrowing at 7 to earn 3, to earn 4. We're hoping that at least they're borrowing to earn 7. So now you can see that my net cash flow picture includes this green box, income from asset. Okay, so what I show, same example, but what I show now is that at year 5, we've borrowed the same $3 million and we've purchased real estate with it. The $3 million of real estate that I've purchased is now producing income at 7%. Trust me, I know that you're all looking at this saying, wow, Frank, that's superficial. It's very bang on, right? It's very clean. And I've done it clean on purpose to kind of prove an example. So if I go through the numbers, what's the cash outflow on an annual basis? Well, Mr. and Mrs. Client, you've borrowed $3 million. We know that 7% of $3 million is $200,010. $210 is your cost of interest. But if that asset is producing at least 7%, then you now have the cash flow to satisfy the interest paid. Go another 5 years, borrow the next $4 million, and now you can see my column here showing real estate purchase of $7 million. Mr. Client, Mrs. Client, that's $7 million. Now the financing cost on it is $490,000, 7% of $490,000, but we're producing income. And what I've actually shown is that the cash flow needed from this is nothing. We actually have cash flow neutral. We've borrowed, and the asset that we've borrowed is producing enough income to cover the interest. And by the way, for those of you that are tax savvy, you're probably looking here and saying, Frank, you're missing a column. You're shortchanging yourself. And the answer is yes, I'm trying to keep this simple. I'm shortchanging myself because I'm not including the Section 21E.2 deduction, right? We also have that deduction to boot, the extra tax deduction for lesser of premiums paid and NCPI. So the last thing that I'm going to focus on this slide is that, of course, when you buy this real estate asset, the individual that bought it because they want capital appreciation on it. So I just put a 3% annual growth on that asset. And now, not only does this individual have the insurance, they've bought that asset that they would have bought if they didn't buy the insurance with the cash flow of $678 per year. They have that asset. That asset is producing income to cover the financing. And of course, the asset is appreciating. At life expectancy, that asset is worth, let's say, about $12.5 million. But what we've also done for this family is we've created after-tax proceeds of roughly $15 million. We'd need a 16% rate of return in order to equal what we've done here. And we've given that client that real estate that they've wanted, that real estate portfolio that they wanted to continually increase. Is it superficial? Yes, this example is superficial, but it's not way out there. It's superficial for purposes of illustrating why we access our capital and why, most importantly, we give the client the access to their capital so that they don't feel like they're losing out on opportunity cost. What could the $7 million that I put into an insurance policy have bought me? We bought it for you. Yes, granted, the income that it's earning is covering the financing charges, but you bought a policy that's going to yield you $15 million after tax. And I always like to show a couple of schematics, but this is really a schematic. I won't even go through this because I think the group has seen this. What I'm going to say is that you have three fantastic resources, actually two fantastic resources in Chris Britton and Brad Hyde, and you got me. Please, if you want help on this, if you want help understanding this, or if you need help working with a client, please tap on any of our shoulders and we'd be more than happy to help. Some of the variables, some of the risks, again, I don't want to talk about this because I think that the industry, we beat that point across so much. But let me summarize so that I can pass it over to Chris. All life insurance concepts begin with a need for life insurance. Entrepreneurs and business owners know that they have that need, but they believe that the opportunity cost of paying for insurance premiums versus access to cash is too high. Nope, I can do a lot better than the insurance policy that you're selling me. Sorry, not doing it. Without a doubt, a prime rate of 7% versus 3%, yeah, it's going to be a little bit tougher for us to show the borrowing. But again, let's try different ways of showing borrowing. And then, of course, what are we going to use the borrowing for? By presenting the IFA with some flexibility, maybe showing delayed borrowing, realistic cash needs for some clients, we've unlocked the myth of lost opportunity costs when purchasing life insurance. The decision to borrow at a certain rate, regardless of the asset that is pledged, comes down to the ability of the borrower to earn a rate greater than the borrowing cost. Captain Obvious. I'm extremely obvious here, but that's the importance of this. Is 7% a rate that is too high for you to earn? Well, if you can't earn more than 7%, don't borrow against your policy. On that note, I'm so sorry, Chris. I went a little bit longer, as Don always says. You say you want 15 minutes and you end up taking a lot more. I apologize, Chris. Over to you.
Hi, everyone. For those of you who don't know me, I'm Chris Britton, one of the directors of tax and estate planning at IDC, along with Frank Abate. Very good job, Frank, on the IFA presentation, and Brad Hyde out west. I'm just going to provide a quick little tax update for 2024. And the theme of the tax changes for 2024 is reporting, and more reporting. So first of all, there's a personal tax update. I'm going to spend time on the new AMT rules. I'm going to briefly talk about the new GAR rules, and there's mandatory reportable transactions, and also new trust reporting rules that come into effect for 2020 for trusts in 2023. First of all, basically, there's no changes in tax rates for 2024 for personal tax, but the basic personal amount is up by $705, and basically all of the marginal tax rates, the taxable income numbers for the marginal brackets, all increased by the CPI index, which was 4.7%. So you can see the comparison between 2023 and 2024, and you can also see all the tax rates are the same. This is just the federal tax. All provinces have their own marginal tax rates. So, like in Nova Scotia, for instance, we don't index our brackets each year. So we've got what's called bracket creep. But from a federal standpoint, if you made $250,000 in 2023 and you made $250,000 in 2024, your federal tax bill is down by approximately $1,185. So a little bit of tax savings, which is good. The RSP limits have gone up to 31,560. That's what you'll be able to put in for 2024. TFSA limits are going up to 7,000. The EI rates went up slightly, and the maximum earnings also went up. CPP rates stayed the same, but the maximum earnings went up, and they also added an additional bracket where if you earn between 68.5 and 73.2, you have to pay an additional 4%. So if your employment income is over 73.2, you pay an extra $188. Oh, and I also just thought I'd mention, this isn't on my slide, but if you drive your car, or you can repay yourself in 2024, it's gone up by 2 cents. So you can, first 5,000 kilometers, you can get paid tax-free 70 cents a kilometer, and then it's 64 cents a kilometer for any kilometers after that. So was big changes made to alternative minimum tax, and I think that the reason that they kind of were looking at the minimum taxes, there's been an awful lot of planning going on with private companies and converting what would otherwise be dividends into capital gains. And they tried to block it a few years ago, but the legislation that they drafted had significant unintended results for other from other areas of the Income Tax Act, so they had to get rid of it. So I don't know if anybody knows at AMT. Generally speaking, you only kind of run into it in the current environment when somebody uses their lifetime capital gains exemption, because there's an add back. So basically, every individual in Canada has to calculate their tax two ways. They calculate it the regular way, but then there's a parallel calculation that is for AMT. So there's a number of things that you add back, like if you have flow through shares, that you get a big deduction from, like the resource. That's another time that you might have seen minimum tax triggered. And any minimum tax that you paid, you continue to do the parallel calculation for the next 7 years. And to any extent that your regular tax is more than the minimum tax, you can actually get it refunded. But sometimes you have to do some planning to be able to do that. So there was some pretty significant changes that they have brought into effect. So starting January 21st, 2024, the flat tax rate is going from 15% to 20.5%. So that's a significant increase, which will trip people into AMT significantly more often than before. However, the previous exemption was 40,000, and they increased that to 173,000. So it won't apply to anybody who has income under 173,000. So this is really targeted at high income earners. So currently, if you had a capital gain or a business loss, you would, for the purposes of calculating your AMT, you would add 80%. So basically, you can still have 20% for free, but so instead of 50%, the inclusion rate is 80. They're bumping that up to 100. And if you had lifetime capital gains exemption, you would add 30% in for the previous regime. Now they're going to add, sorry, that one hasn't changed. They're both 30. What I don't understand is what they've done is they've now also said that if you have a gain on a gift of property to a charity, previously there was a zero add back. Now it's going to be 100% add back. And if you had a gain on a gift of a publicly listed security, there's going to be a 30% add back. Previously was zero. So, and on top of that, the refundable credits, such as your donation credit, they are basically, the donation credit previously would reduce AMT. Now only 50% of the donation will be reflected in your AMT calculation. So it's going to have a significant impact on large donations to charities, because you can actually end up increasing your tax bill by making a donation, which I'll show in the next slide here. And these are so the 20.5% is only the federal rate for AMT. There's also provincial rates, but they vary by province. The lowest AMT provincial rate is in Ontario. It's 33.67. But in PEI and Nova Scotia, it goes all the way up to 57.5. So that would be 57.5% on top of the 20.5, or 57.5% of the 20.5. So as an example, let's say we've got a client who has a large capital gain on the sale of a company. So if he had a $25 million capital gain, in the regular tax calculation, currently you would have $6.5 million in taxes payable. If you'd had that gain in 2023, the AMT calculation, so you can see you add back 30% of the gain, so you add back 15 million. Yeah, that 15 million. So the AMT for sale of private corporation share was in 2023 only 5.99 million. So therefore there was no AMT because the AMT calculation is less than the actual tax calculation. Well, because now we're going to add back all of the gain, you can see that now the AMT calculation on that gain is 10 million. So the client would be subject to $2 million in AMT. So they have to pay 10 million currently, and then they could have the ability to get some of that, the 1.9 million back over the next 7 years, but they would have to fund it currently. It gets worse if we add in a donation, though, which is mind-boggling to me. So if this person sold their company for $5 million, and then they took $5 million of that proceeds and donated it to a charity, the actual AMT goes up to 2.8 million because we have to add back half of donation credit. So previously there would have been no AMT, and now it's almost 2.8 million. And if they did that using if they did that using publicly traded shares and we had a small gain on the shares, we have to add back 30% of that, and then increases the AMT to 3 million. So in high net worth planning cases with capital gains, they have certainly increased the tax that someone's going to have to pay with the AMT rules that they've brought in. Okay, changes to GAR. There's been a lot of debate in the tax world as to exactly what these changes mean. They changed the definition of an avoidance transaction from the primary purpose of the transaction was to obtain a tax benefit to the main purpose of the transaction. Now, that definition was changed both here, so that makes it that the mandatory reporting rules have the same definition of an avoidance transaction. So they've also the misuse and abuse of the act is been extended to have a definition of significantly lacking in economic substance. So what does that mean? All of the opportunity for gain or profit or risk of loss to the taxpayer basically remains unchanged before and after the transaction. So, and it's also reasonable to conclude that at the time of the transaction and the series was entered into, the expected value of the tax benefit exceeded the expected non-tax economic return, and is reasonable to include that the entire purpose for undertaking the transaction was to obtain a tax benefit. So this is an expanded definition, and I just want people to know that GAR is probably going to apply to more transactions than it did before. There is extensive explanatory notes, which I think Department of Finance wants to give the courts more background into what they're thinking when GAR should apply or it shouldn't. But one example of where they say the new rules will apply is with the surplus strips. So that's the transactions I spoke about earlier, where business owners were creating reorganizations to turn dividends into capital gains. So, saving them about 20% on their tax. And the other thing that they've done is, before GAR would only basically tax you on the tax that you otherwise would have had to pay. But now they've got a new penalty of 25% of the tax, unless the transaction was reported to the CRA, either under the mandatory reporting rules or voluntarily reported. And if the GAR rules apply, there's a 3-year extension to the normal reassessment period. So they've got an extra 3 years to apply GAR. Changes to the mandatory reporting rules. So these have been in place since 2010, and it's basically to catch aggressive tax planning. So basically there's 3 hallmarks that they want to look for. So one is a contingent fee based on success. So a fee that was charged based on the tax savings, and a contractual protection. So that would mean that if it was ever challenged the taxpayer would receive the fees back, and a confidential protection. So before they brought these rules in 2010, if there was an aggressive tax plan done, they would generally make the client sign a confidentiality agreement so that they wouldn't disclose it to anybody else. When they brought these rules in, most places got rid of the confidentiality protection, got rid of the contractual protection, because if they did that, they would be out of these rules. So there was a lot of transactions being done that because they took away those second two things, that they didn't have to do the mandatory reporting. Well, now what they've done is it meets one of the three hallmarks. So if there's a contingency fee charged for the tax planning, then they'd fall in under the mandatory disclosure rules. So these are any transactions entered into after 2023 or June the 22nd, 2023. And it also applies to a person who gets the tax benefit, or a promoter or advisor. So if you are involved in a transaction and advising the client from a tax perspective, you also may be, if you are an advisor inside of that group, you could be subject to making the mandatory disclosure. And the penalties for not abiding by the mandatory rules is 100% of the fees charged, plus $10,000, plus $1,000 per day, up to a maximum of 100,000. So the penalties could be significant. And lastly, the new trust reporting rules, which I think are going to catch a lot of people by surprise. So all trust returns for 2023 are going to have a new form that you have to add to the trust return that gives detailed information about the settlor, the trustees, the beneficiaries, and any person who has the ability through the trust agreement or related agreement who can influence the trustees. And they want to have their names, addresses, dates of birth, jurisdictions, and residence, and their tax identification number, which, if you're Canadian, it's your SIN number, or if it's a corporation that's a beneficiary of the trust, it's the business number. And the reason why I think it's going to catch a lot of people by surprise is that these trusts, the old rules, you didn't need to file a trust return unless there was income, or if there was a capital disposition, or if there was, income reported out to beneficiaries. But now every trust has to file, including bear trusts. So what's an example of a bear trust? So they're used a lot in commercial property transactions, but you could also potentially have a bear trust if a parent co-signs a mortgage. So they're on the deed, but they don't have beneficial ownership of the house, or in trust accounts at the bank. Now, there is an exemption for trusts that have less than $50,000 in cash and investments. So, at least there's that. But I think there's a lot of people that are going to be subject to these bear trust rules that don't realize that they are. And the other thing to keep in mind is there's a lot of these family trusts out there that have beneficiaries, and the beneficiaries don't even know that they're beneficiaries. So the trustees are going to have to go potentially tell some beneficiaries that they need all this information from them, even though those people didn't know that they were beneficiaries. And even though most trusts are discretionary trusts, they might feel like they have an entitlement to property that the trust owns. And finally, all beneficiaries of a trust are deemed to own the shares of the trust. So there could potentially be, I think that CRA is going to use all this information to see if you're a business owner and you didn't know you were a beneficiary of another trust, you may end up having to have an associated company and share the small business deduction. But I think my time is up. So thank you very much for paying attention, and I hope you found that useful.